So my system is basically, Vivekji, I accept bets on both sides. I accept bets on both sides because the way to look at it is, as an individual, as a person in general, I prefer having a high win probability. I want to win most of the time because as human beings, I think we're psychologically programmed that we should win, and that'll keep our morale high and confidence high. But at the same time, when I lose on that high probability trade, my idea is cut those losses quickly.
Okay.
So what I try to do is, for example, I will go over my analysis. There are three things that I analyze. I analyze the charts first. I look at the open interest and I look at the pricing of the options itself.
Okay.
So pricing of risk will also give away a good amount in terms of what can be the market volatility. So I will just go over now. Let's, for simplicity's sake, look at it on a 1 hour time frame. Even if you know nothing about technical analysis, anyone can identify the swing highs and swing lows.
Correct.
Right? So let's look at the basic swing highs and swing lows. We can say this was a swing high.
Right.
Right? This was a swing low. This was made in a bit of a panic. But and how many days in this? Just look at the past 10 days maybe, not more than that.
Okay.
And the closer the date, the more important. Any particular swing, the closer, the more important. Now we can say that, okay, here also we can see 1, 2, 3, 4. Many times this has acted as a particular level, right? So we can mark that as well. And on the downside, this zone. Once again, right? 1, 2, 3, 4 we can see. Now this has roughly given us what range Nifty is trading in.
Okay.
Right? Nifty, we can say the super broad range is 17,600 and 16,400.
Okay.
Right? And we can say that, okay, otherwise the range that we can work with is about 16,850 and on the upside 17,300.
Okay.
Right? What I want to do is above this and below this, these two particular lines that we have marked, I want to try and sell options there.
Okay.
So what ends up happening is those options will most likely be trading in a downtrend.
Yeah.
Right? It is very simple, and they will not react too quickly to the movements. If we trade here, if we trade at the money or close to money, especially when the implied volatility environment is low, then there's a good chance that we get pushed out. If you're trying to play both sides, it becomes too aggressive when you're too close to the market. So I try to sell above this line and below this line.
That is because of the delta, right?
That is because of the delta, because there will be higher delta the closer you are to at the money. So that is one thing that I look at. The second thing that I look at, and this will come to OI.
So when you say you play, that means you sell.
I sell, yes. So I'm taking a high probability trade. So I'm selling both the options.
Okay.
I'm selling both the options. I'll get into exactly which options I select. Second thing I want to look at is the OI. And now here intraday OI gives us how the market has been positioning. Now today we had a gap down opening. From there we have seen very strong put writing all the way till 17,000. Right? So that shows you that people who are writing these put options, they believe the downside is limited. And that's why we can say that, okay, market has after the gap down continued to move up. The second thing to look at is point of maximum congestion. This is from the overall OI. Point of maximum congestion is nothing but the point where there are maximum number of call plus put.
Correct.
OI.
Correct.
Market has a tendency to always move towards this point of maximum congestion.
Right.
If the market, like for example in my trade, if I want to create a bias, I will always create a bias that the market will move towards the point of maximum congestion.
Okay.
So if we gap down, then I will have bias as a good chance that we get pulled back till the point of maximum congestion. Now, as we head higher, my bias would be that no, we'll come back to point of maximum congestion. And also, we get to see that where majority of the market is positioned. For example, let us say there was big 16,800 here and 17,200. I want to sell strikes which are beyond these.
Okay.
Because these are the guys who are first at risk. The thing is, by the time the risk moves on to the further away strikes, by then I would have long gone with my stop loss. So right now, from looking at maximum congestion, we also get to see what is the pricing of risk. Pricing of risk is basically the price of the straddle, sir. So right now, the 17,000 put option and 17,000 call option together are trading for about 250 rupees.
Right.
So the risk that market is pricing in is 250 points on the upside, 250 points on the downside. So that gives you an expiry range of 16,750 on the downside and 17,250. That
Correct.
is that you basically add and subtract
Correct.
from whatever that point is. Now, I want to ensure that whatever strike I sell is at least one strike away from here.
Okay.
So the minimum that I would want to sell is 17,300 on the upside and 16,700 on the downside.
Sure.
What this gives me is, because my trade is only for the day. I mean, this is pricing all the way till expiry.
Oh.
My trade is going to begin and end today.
Okay.
So I want to be in a position which has a high enough probability that today itself it makes money for me.
Okay.
And I'll go over this as we this thing. And my trades also, I log them, I put them up. All the trade logs are available, people can see. So that is how I select my strikes. So in the morning, okay, so forget in the morning, because the best time to enter will be in the morning. So after the first 1, 2, 3 candles, that is the best time to enter.
What size of the candle? 5 minutes?
5 minutes,
Okay,
yes.
okay.
5 minutes.
So that means after 15 minutes candle.
After 15 minutes, right? Sometimes as you spend more time doing this, you'll understand that there might be a advantage in entering in the first candle itself.
Yeah.
Because, for example, there's a big move. Generally, what happens is if there is a huge gap down, there is an increase in fear. In the first candle, there's a huge increase in fear. And based on the previous day pricing, see, Vivek sir, nothing comes without putting in work. You need to, I have been watching weekly expiry prices of straddle, 100-point strangle, 200-point strangle for 100 plus weekly expiry. So I've been watching it for 100 plus weekly. So I know how the option at this much distance is going to behave simply from muscle memory of viewing it. This doesn't take genius. This is not genius. This is hard work. You need to understand that, for example, if a 300-point spread has closed at 60 rupees today, let's say it's a Tuesday or something, and next morning is opening at 60 rupees or a little bit more than 60 rupees, I'll be happy to enter it in the first candle. But if it's opening at 50 rupees, then I will wait.
Got it.
Because whenever there's an increase in fear, you want to short IV into that. But what can happen, it can open at 60, it can expand to 70 before reducing. But that's why there is a defined stop loss, right? So there's always a risk, and you need to specifically define before entering my trade. If I'm shorting a 30 rupee option and hoping to get, let us say 10 rupees on both sides to make 1%, 20 points, then I need to know that if it goes to 70 for whatever reason, I need to get out. I have to, because I've given up 0.5%, I need to get out. So what I would do at this point of time in the market, let me go. One more thing that I always like to do is have roughly equal premium in both my legs.
Okay.
Roughly equal premium. So let us say I want to sell any put option below 16,700, and on the call option side above 16,300. So I can actually sell these two strikes itself. This has 28. This will be my trade for today if I were to enter right
17,300.
Yeah, 17,300, because both are 250 points plus, and I mean 300 and 300. Right now this has 27 rupees and this has 27 rupees.
Okay.
They are almost perfectly equal.
Okay.
Right? But the call option is only 250 points away.
Yeah.
Whereas put option is 350 points.
Yeah.
So naturally what will happen is, in case there is an up move and if you are equidistant, then you will actually make a profit, because a strangle is actually a bullish to sideways strategy, because there will always be more premium on the put side because people are more afraid on the put side. But how I like to structure it is I like to have equal premium.
Okay.
In case the market moves up, first thing I want to define. So this is my trade. Before this trade, how much can I get on this? Today being a Monday, I don't get much DK.
Why?
The thing is, how way options behave is towards the fag end of the expiries when most of the premium falls off. On a Monday, there are two reasons why. But first of all, it is away from the expiry. Secondly, US markets have not opened. We don't know what kind of volatility will play out there. So whoever is placing or accepting bets in the market will not give up too much value. Those bets will not give up too much value on a Monday. So on Monday, my preferred approach is to trade small sizing, keep a small target and keep a small stop loss.
Got it.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.